So we're asking the question, is new international prudential authorities needed? Of course, as noted in the last session, our financial institutions are like national utilities. They're actually international utilities, and that raises problems, and that's what this panel is supposed to discuss. We'll go in a slightly different order. Stein will go first, talking about settlement of G-SIFIs, global SIFIs. Then Asla will talk about monitoring incentives as a format of international regulation. And Katarina will wrap up with the argument for against international standardization. So, Stein? He only has 31 slides.
Thank you very much, and thank you for inviting me to this conference. It's very fascinating to get the different perspectives, the legal, the practitioners, and the economists. I'm the economist here. This is a joint, at least is based on a report that we wrote joint with Dick and Dirk Schoenmaker, although the presentation that I will present is not necessarily based on the whole report. That's obvious, of course. I only have 31 slides as opposed to 100 slides. But also, it doesn't necessarily represent the views of the whole team when we produce this. So Dick is for sure excused for what I'm going to say next. So the idea when we wrote the report was to look at global SIFIs. We did this, so you see, 2 years ago, it came out as a Geneva report. At that time, I think we were still behind the curve in terms of what the practitioners were doing, but the practitioners have still not caught up to us. So agenda for the presentation today, a little rise of the global SIFIs. I think that's obvious. What's the problem with global SIFIs from kind of a conceptual point of view and a practitioner point of view? Taking a few case studies and particularly focusing on the current ongoing European Union crisis. And then talk about what we call the financial trilemma, which is a term Dirk Schoenmaker has introduced and been using for a while, as to what are the difficulties of reconciling cross-border financial integration, national sovereignty, and regulation, and what kind of solutions might exist. And I'll go through some reform options that we tabled in the report, and I'll push for one particular one, not necessarily that the team as a whole agreed to it, but I think one that has become more useful, which I call the universalism approach, and then a few complementary steps in a summary. So the rise of SIFIs, I think, is very obvious. We have talked about it. We now have at least a list from the FSB 29. The insurance list are debating whether or not to do it. And as we have heard many times today, it can be extremely complex. We have some numbers in the report, how many subsidiaries there are. We heard today Lehman had 6,000. We talked about thousands of them in the individual ones we studied in many countries, and complicated in terms of asset structures and also large relative to economies. I think that's obvious. The large relative to the economies is something that is more prevalent, of course, outside the US, because you talk to UK, RBS, it was about the same size as the UK economy, whereas Citibank was only 10-15% of the US economy. So there is a scale difference here to take into account. Clearly hard to manage. This economies of scale scope, we said it's unclear. We didn't have the benefit Loretta study at that point in time. I think there are nevertheless a lot of anecdotal evidence that there are some questions to be made about this, whether or not the scale and benefits are there. And regardless, we do know, of course, that they're very hard to unwind in times of crisis. And much of the support went to these global SIFIs, and I will talk more about that next. So what is the challenge, how to deal with them, with the cross-border impact, particularly of a failure? We stress the failure, but as the end game that people in the past at least tended to ignore. Now, thanks to the crisis, we are realizing it a little bit more, but nevertheless, it's still the part of the total picture that gets the least attention, because we talk about regulation and the like, but often incentives are shaped by the end game. And we should really start from there, particularly on the cross-border side, when we look at how to regulate and supervise these large institutions. And the problem there, when you take this perspective to the cross-border side, is that we have these externalities, right? So we have one institution that operates across borders, and the failure in one institution is going to affect other countries. And then the question is, who's going to take that effect into account? Will the national authority ignore that, which means that the failure of that institution will have adverse consequences for the other countries? So if RBS would have gone under, yes, it would have been bad for the UK, but it would also have been bad for many other countries. Now, yes, the UK did intervene, but there are many cases, and I'll mention a few, where that was not the case. And often, of course, we also get this perverse effect that, yes, they do intervene, but in a kind of an ad hoc, perverse way. And I think a lot of what's going on in the European Union now is probably in that category. But there's not as clear set of rules, and we're creating new set of spillovers that we like to avoid as well. Why is that? Well, in the end, accountability is to the national politicians. We've heard a lot about that, why people are beholden to politicians more. I think local interest groups is also important. It's not just the domestic taxpayer in this consequence. Legislation, of course, so far at least we've only had nationally based legislation. By definition, one would say, well, yes and no. I mean, there are other areas where we have seen more international legislation already operating. It's not just, it's not impossible to do that across borders. And lastly, of course, there's difference in fiscal, financial, and supervisory capacity. So an Icelandic banking system that was probably too large for the country to begin with to grasp, it was definitely too large to supervise, creates spillovers to other countries because of this capacity constraint that didn't match up with the banking system in that country. So this is a picture. Nationalism, my country is my castle, creates a lot of these kind of parochial views that leads to these international spillovers. Now these spillovers can be particularly problematic, of course, for the SIFIs, for these global SIFIs. In this kind of a diagram, you can think of the host on the vertical side and the home on the horizontal side, and then the bank can be systemic in the host country or non-systemic, and vice versa, it can be systemic in the home and non-systemic. And it's along the lines of the diagonal, we don't have potential for coordination, or we don't have coordination problems to begin with. So if you're systemic in both countries, then you may see these two regulators starting to collaborate because they want to preserve the SIFI in a meaningful way. But if the one is too non-systemic in the host country, for example, then it's not a problem. But if it's systemic from the host point of view, but non-systemic from the home country point of view, and think of, in this case, of foreign banks in emerging markets, which are typically very large for the host country, but not very important for the home country, then we've got these conflicts between the host and home country and a lot of potential for coordination problems. I mean, the case studies bear that out. Lehman, I think we have talked enough about Lehman that we all know this, but just to highlight again, in the end, between the US and the UK, there was not enough coordination because there was clearly an act of unilateral on the part of the US that led to an orderly resolution of the US broker arm with Fed funding, but it did not deal very well for the UK perspective, of course. In that sense, there was no cooperation in the unwinding. And the message to London was that bankruptcy legislation is national because the time difference and it happening over the weekend, the UK was left with a lot of losses, at least with a lot of problems. It's not the only case. If you go to some other cases, Fortis between Belgium, Netherlands, and Luxembourg looked like a cooperative case for one weekend, and this is between Belgium and the Netherlands, which otherwise you would think are reasonably well cooperating in many ways. They had many MOUs, they've been meeting on many, many occasions. Nevertheless, after that first weekend, the second week it came around when really push came to shove, and then the cooperative solution collapsed. Dexia, another case, Belgium, Luxembourg, France, looked very good for a while. This one lasted a little bit longer as a cooperative solution, but then the second round, which came very recent, we still saw a default. So we know these things are not easy. The overall case record, if you go, maybe hard to read, into some other cases as well, the Icelandic banks, it's a mixed bag. It sometimes happens, sometimes it doesn't. But overall, we would say on the global side, we still have a very poor record of resolution of large international institutions. And even if they're smaller, like the Icelandic banks, it's not very well done as well. And that also applies still to cases that you can easily conceive to be a problem going forward. So if you take Deutsche Bank, which has a large branch in the UK, which is probably a third of the total banking balance sheet of Deutsche Bank as a whole. And if you ask the question, what happens to that branch if it runs into trouble, who's going to support it, we don't know the answer. This was a question phrased by one of my co-authors, Dirk Schumacher, in '97 with Charles Goodhart. We still don't know who is going to step in if Deutsche Bank runs into trouble. Is it going to be the Bank of England? Is it going to be Deutsche Bank? Is it going to be somebody else on behalf of Germany? So we don't know who is going to help out here. And I would then take you to the current ongoing crisis experiences, where we actually have even a worse situation. We have the situation where weak banks in periphery countries, I'm talking about Greece, Portugal, Ireland, Spain, leads to perverse bank sovereign links because the bank is dependent on the sovereign for its support. The sovereign is being stressed already and is getting the additional contingent or direct exposure to the banking system. That threat or the risk of default has spillover effects. It leads the European Union, the ECB, and others to support those periphery countries with large financial transfers. I would argue that the transfers implicitly happening in that are of a scale that we haven't seen before and clearly wouldn't have been conceived as part of a fiscal or a monetary union. But it's a very messy process, as we know, right? I mean, we're still struggling and suffering from it every day. In that context, European policy did not address what we call this financial trilemma. So we had in the European Union too big to fail banks driving sovereign risk. We had the flags for in various countries looking for money for a bailout, but it led to very messy and ongoing sovereign problems. So what is the trilemma? And coming more to the solutions of that. So we have these choices to be made between these three aspects: global financial stability, cross-border banking, and national authorities. What do we want? Can we have all three at the same time? And you have to make a consistent choice among these three and not be modeling yourself within a corner solution, thinking you can live in that solution alone. And here we think there are kind of two possibilities to look at the corner. One is a territorial approach. Basically, you set yourself up as national countries with a ring fencing on the one system, on the one domain. Or you go for the universal, where you have an equity distribution of the estate with some burden sharing possibly. And the intermediate approach we call the modified universal approach. Let me quickly take you through these three approaches. So the territorial approach is, of course, very attractive in the sense that it gives you fiscal independence. You don't have to burden share. Everybody's on their own. Each country has its own subsidiary, is completely ring-fenced and segregated, and it gives you better incentives for local supervision. But as already was alluded to earlier, there's a lot of cost. You can't move liquidity around. There's no at all interest in taking the global perspective into account. You're not going to get good cross-border supervision that way. And in the end, it's probably an inefficient model because you have this subsidiary model and that is not consistent with global banking. And I think my main concern would be that in terms of a political point of view, this would get us towards to more inward thinking, and probably politicians and the banks are getting closer together rather than further away if we were to pursue this model. Universal approach, of course, is very demanding. It's clear the Home Authority would be in charge of resolving an institution across the globe and distributing everything. It doesn't necessarily avoid the conflict of interest because still this home host, if you have a small country that has a large foreign bank in it, it might still have a conflict in terms of what the host would want to do. And you still need some burden sharing arrangement. So the universal approach is quite demanding. It also would want the SIFI structure to match with that, preferably, if the SIFI structure is organized still very local, then this universal approach doesn't really do as much for us. It's probably in any case not very likely to happen, and it may not even be desirable to begin with. When I presented this before, at some point people say, well, it's not even feasible, it's not even desirable, because you're going to put in a lot of faith in this global supervisor, this global regulator that's going to take care of the global public good, so to speak. It might even increase the burden overall if it leads to free riding. So I agree with that. At the same time, I think there are some process parts that can be introduced. We've had UNCITRAL, WTO, and other ones already operating on a more global or regional basis with certain rules that transcend across borders. So I wouldn't say it's impossible. And nevertheless, and there are some sanctions that come along with these procedures, but it's probably not a good tool for crisis management as it's being too slow. Having said that, for some countries, and this really takes me back to the European crisis, I think for some countries it could be a good one to phase in, because these are so closely integrated, European unions, particularly the Eurozone, that in some sense they already made the choice in this financial trilemma between having integration and a common currency. They should move next also to this more global integrated supervision. And I think one way to do that is through a European bank charter. So you basically allow these entities to be rechartered themselves according to a European regime, where they can then get supervised as well as resolved possibly according to the European general framework, with a single authority that has all the tools. Of course, it requires a lot from that centralized system, but we've seen the local systems not performing well. So I think there is hope that a centralized system that's also not so politically connected can perform better than this current decentralized system. It can be introduced flexible. So one of the advantages of a new charter could be that you go outside the current system, offer it to the existing entities and saying, this is a lower compliance cost, it has some benefit for you, you can report to one entity, and as a consequence, you can function more efficiently. And it creates a little more distance as well. It can be combined with burden sharing. Burden sharing, of course, is in the end the key factor for how we're going to organize that. Are we going to have some deposit insurance or some recapitalization fund that will back this up, this European bank charter? And that, I think, will be hard to organize and will be difficult to phase in. But I think it has to be considered because the current solution is not so well. So for other countries, I'm more with what Charlie and others have mentioned earlier today, an intermediate approach. Let's get these other countries, the US, UK, Japan possibly, maybe with the European Union, to think about and harmonized rules where there's more integration. I think there are quite a few steps on the way already, but I think more needs to be done, particularly in the crisis management. All of these approaches, including this intermediate one, but also universal one, needs all of these other things. This is where Dick has mentioned. You need the living wills, you need better rules, you need possibly also new concordat. Without that, all of this, of course, is not going to work very well. But I think collectively, I think at least it's an internally consistent approach to deal with this problem of the global SIFIs, and it particularly avoids a territorial approach, which I think we're heading towards if we're not careful, because we're going to be ring fencing too many, and that may lead us to a race to the bottom rather than a race to the top. Thank you.
Stein, thank you very much. Asla?
Well, let me first start by thanking Charlie and Ira for having me at this conference. It's a pleasure to be here. And also the usual disclaimer, of course, applies. I'm speaking for myself, not for the World Bank. And indeed, as I tend to say in many of my speeches, for the most part, most people in the World Bank probably disagree with what I'm saying. So Okay, so today I'm going to talk about regulatory reform as a result of the financial crisis and where we should be heading, but more in an international framework, so that's why I'm in this panel. The first, I think, place to start is to discuss the causes of the crisis, to figure out where we should be going from there. So this is another area where there is relatively little agreement where I'm coming from, but for me, for the most part, obviously there was a lot of issues and a lot of reasons for the crisis that range from the macro policy and global imbalances. But when you really look deeply and carefully enough, you realize that it's really the microeconomic policies that distorted the incentives that were really the underlying cause of the crisis. So the real cause was the subsidization of mortgage risk, regulatory failures, corporate governance problems, and the like. So what does that all mean? So what lesson do we take from this? So probably the most important lesson that we should all be taking is that the regulatory reform, the good regulatory reform, should really address incentives. We really need to reform so that we address the incentives of the banks to avoid effective regulation, and also incentives of supervisors, regulators, and politicians to forbear. If you look at some of the issues, I mean, the problems of risk measurement, making sure there is enough capital that is commensurate with the risks that were being taken, as well as maintaining this capital, were certainly not problems of incompetence. It was much more problems that were there because of incentive issues. So, okay, a lot of people already said this in this conference, and that's one of the drawbacks of speaking in the last panel. But the main problem is how to do this, right? If we all agree, say we all agree that we're going to try to address the incentives, what type of a framework can we have in order to do that? I have basically three thoughts. Again, many of them have been mentioned at the conference, but I'll try to give you my perspective. The first one is the transparency and simplicity, the regulations, the importance of having simple rather than complicated regulations. The second one is, again, we've heard this quite a bit today, the too big to fail. What I'd like to say, unless you fix the exit mechanism, it really becomes extremely difficult to have effective regulation. And the third one is to completely reorient the whole approach to regulation from auditing core principles to conducting incentive audits. And I'll try to talk about all these in an international context again. So first, the simple versus complicated. Well, we certainly know that the crisis challenged the Basel framework in many important ways. We saw flaws with the external ratings. There were problems with the accuracy of internal risk models, lack of disclosure, transparency, and so on and so forth. My colleagues at the fund, Enrica Detrajaki and Oerde Marush and I, we thought that perhaps by looking at what happened during the crisis period, we could learn something useful about the possible redesign of bank capital regulation. So what we did is we took data for 381 banks in 12 countries, and we studied the quarterly stock returns over 2006 and 2009 period. So the idea here is if we take the crisis that started in August 2007 as an unexpected negative shock, we try to explore whether the market participants really perceived different capital definitions to be effective measures of banks' ability to withstand stress. So we know that pretty much most banks, almost all of them, suffered during the crisis, but some did better than others. So were those the ones that were better capitalized, and which concept of capital was most informative for market participants? So in this paper, with a little luck, it's forthcoming in JMCB, we find that indeed, during the crisis, stock market investors placed higher value on better capitalized banks. But the concept of capital that was really informative was not the complicated Basel ratios, the risk-weighted Basel ratios. The concept of capital that was most informative was the simple leverage ratio. And simply because the more complicated, more sophisticated ratios did not have that much information. They were subject to regulatory arbitrage. They were not very useful for the investors, and they simply ignored them. So we also find that there is quite a bit of evidence that higher quality Tier 1 capital and tangible common equity were much more relevant for stock market investors. So what do we think this means for capital regulation? Well, this is something that's been said for quite a while now. Shadow Regulatory Capital Commission has been saying this. Required capital for a bank is really complicated to calculate. We know this, and this is for the markets to do. So the capital regulation itself need not be so complicated. For example, all these Basel regulations that still emphasize risk-adjusted capital tend to become over and over complicated over the years, and they tend to lead to manipulation and regulatory arbitrage. So one potential recommendation is to adopt a much simpler, easy to enforce and monitor ratio, such as the leverage ratio, but complement this with signals from the market itself. For example, Charlie has this wonderful proposal to use interest spreads as a measure of risk, which would be relatively easy to adopt in many of the developing countries where we don't exactly know what these risk-adjusted capital ratios mean in the first place. So one of the points that I want to leave you with today is this whole issue of transparency and simplicity, and the need to emphasize this again. And sort of rethink this whole complexity and trying to sort of introduce greater and greater, more and more sophisticated regulations, which simply add to the ever-expanding list of regulations, which the markets seem to readily dismiss anyway. So the second point that I want to make is, again, as I mentioned, fixing the exit mechanism. And what do I want to emphasize here? We've already talked about the importance of credibly addressing the too big to fail problem. And there I'd say, not by introducing size or activity limits, I tend to find it very difficult to think about that, and given all the potential efficiency problems and the difficulty of doing that properly. But certainly by clawing back the incentives to become large and interconnected. And there, again, I mean, there are many ways of doing that, but most try to sort of make it more costly to become large, and there potentially higher capital requirements is one way. But then again, because we know capital itself is a costly way of financing, we want to make sure that we try to minimize the cost of these regulations so that the institutions invest less in order to sort of circumvent them, and that's where the COCOs and the contingent capital type of proposals come in. And certainly the living wills and shelf bankruptcies and the greater crisis preparedness outside of the crisis situation would be very important to make sure that we provide the impression that at least that anytime one of these very large institutions get into trouble, the knee-jerk reaction will not to bail them out. There has been some thought that was given into it before the crisis, even though during the crisis it's going to be very rare that these blueprints will be followed through. At least there will be some notion that there might be a potential to resolve these institutions. And another controversial potentially idea is to phase out explicit deposit insurance for large banks. Now, this might be an odd idea given that during the crisis we've seen so many countries adopt deposit insurance insurance or even expand their limits for deposit insurance. It's again important to step back and think why we have deposit insurance. It's not necessarily to prevent systemic crises. It's there to prevent failure of individual banks. And there we know that this is not for large institutions, since large institutions already have a lot of implicit subsidies. It's to allow small banks to compete and be feasible. And there, if we believe that small banks are important for local communities, and that could be debated, but nevertheless, if we take that, that could be a worthy purpose. But then for the large institutions, at a time when we're trying to claw back all implicit subsidies, it's not obvious why we need to have the explicit subsidies in there. You may think that it doesn't really matter from the viewpoint of a large institution because they're already subsidized and covered. But from the viewpoint of a depositor, the choice then would be to deposit in a small explicitly covered institution versus large institution that's not necessarily covered. So together with some of these other proposals and to sort of claw back the subsidies, this might be one additional way to prevent institutions from becoming so large. So, and finally, I want to mention this whole point about the need to identify incentive problems on an ongoing basis. Now, in the international institutions, both the fund and the bank, as you know, has this financial sector assessment program where we very much emphasize assessments of compliance with Basel core principles of bank supervision. Huge resources are spent in an effort to emulate these principles and assess whether countries across the board are compliant with various rules and regulations, and for the most part, you know, we all these types of operations spend huge amount of time in order to negotiate whether countries are found to be compliant with many of these principles. Now, another interesting finding that my co-author Enrica Detrojaki, who is at the fund, and I have found is when we look at the impact of compliance with BCPs with banks' financial strength, we really find no robust correlation. If anything, the only thing that seems to be correlated with a good outcome is the quality of transparency and information provision. So it's not all that obvious that we are getting our money's worth by spending so much time trying to audit compliance with core principles and ticking the boxes, if you will. Now in a new study with my co-authors at the bank, Martin Jihak and Barry Johnston, we tried to propose something different, which could be a complement to the existing assessment programs, which we call incentive audits. So this whole idea is to try to identify perverse incentives giving rise to systemic risk become a core part of the financial architecture. So, for example, the need for a macroprudential authority is already acknowledged by the international community quite a bit, but most of the time the tools and the approaches that these institutions are supposed to utilize are basically prudential add-ons. What we would propose is that the focus of the macroprudential regulator would be incentive audits as a means of identifying and correcting systemic risk. So similarly, in that way, you could reorient the FSAP program to move away from compliance with principles and codes, or at least complement the program with a audit of incentives through the use of these types of instruments. So thank you very much.
That's perfect. Thank you. Katerina.
Thank you. Oops, wrong one.
Kill me for
I think I got it. Okay. So Again, I would like to thank Ira and Charlie for having me here and allowing me to share some thoughts with you. This has been a terrific day, and I learned a lot. I actually want to go back to something that has been said by Michael Carney this morning, namely that the global crisis has shattered some of our fundamental beliefs about markets and probably also their governance. And I share this view. And so what I want to do today is to probe a little bit deeper in how we could reconceptualize our ideas about financial markets to learn more how to govern them. And in my case is against the standardization of rules and regulations. I've made that case many times before, even prior to the crisis, but for different reasons. So in prior arguments, I usually focus on the ability or the different pre-configurations in different countries to comply with global standards. Here I'm actually arguing more that there are inherent features of financial systems, both domestic and global financial systems, that speak against a universal standardized model. And I would try to explain this here. I will say a few words as to how I think or where I might be departing from Stein and Asley. From their presentations as I've read them beforehand. I want to say a few words about how I would characterize the structure of financial markets and what the implications of that view would be for regulating global finance, and then suggest how we should move towards a different regime for governing global financial markets in the future. So the point of departure is that, yes, with Asley, I think incentives really matter, but I don't think that incentives are the root cause really for the global crisis. There are two fundamental and more existential issues. One is imperfect knowledge. That is, we do not know the future. Nobody knows. Neither do market participants nor do regulators. So the whole idea that we could either write models that tell us how things will work out in the future, or that regulators could develop pre-designed regulatory tools to either create incentives or create codes, I think strikes me as slightly crazy. And what we need is therefore a different approach to regulation. We do not know the future. The second is that liquidity is highly volatile. And we've seen this, of course, in the global crisis. I think I would also argue that this crisis has been a liquidity crisis. And it's inherently volatile. So we have to deal with that too. And that drives, however, also the incentives of market actors. The combination of the profit motive, and that's the driving incentive, of course, for most market participants, with these two factors, imperfect knowledge and the volatility of liquidity, I think is an endogenous process that drives the markets towards instability. And we should start from that presumption rather than some idea of market stability or efficiency. The second point, more towards Stein, maybe, is to say, yes, structure matters. And again, I would start from liquidity and say access to liquidity in times of crisis varies. And it varies across actors, it varies across countries. They are different, and they know it, and they will behave strategically in the knowledge of that. So both actors in markets, but also countries and country regulators will respond to their own perception as to what their liquidity situation in times of crisis will be. It matters whether or not you have the global reserve currency, whether you have the dollar or any other currency in the world. It matters whether you have foreign exchange reserves to bail yourself out or whether you have to be at the mercy of the IMF. And it matters whether you are the one who has to cry, where is my swap line, or whether you are the Federal Reserve that has the discretion to decide whom to throw that swap line. So in short, we have two different structural views of financial markets. One is to say still that the markets are efficient, that there's some kind of equilibrium outcome, that therefore any deviations from this outcome would suggest some distorted incentives and institutions that should be fixed. The most important fixes are typically disclosure, transaction cost reduction, or incentive alignment. And I'm not saying that all of that shouldn't be done, but I think we should recognize that this is never sufficient to get at the desired outcome. And then the third assumption is that regulators actually can fix it. First of all, that they know, that they might know more than market participants do, and I would disagree with that. And then the other is that most regulators around the world share actually the same goals. They all want some kind of stability of the markets. But if it's correct what I said before, is that they're positioned differently, then they do not share the same goals, and they will behave differently, especially in times of crisis. The alternative view that I want to present here, and that builds on a different type of economic history, I think you can trace it back to Keynes and Minsky, and more recently Perry Mehrling at Barnard, is to say that markets are inherently hierarchical. That follows from the fact that we have different access to liquidity. We are not all even. So the ability to convert my claims into cash here and now, especially in times of crisis, determines my survival constraint, and that differs among actors. Now, we can manipulate the survival constraint. Rules and regulations do that, and my strategic behavior can do that too. So whether or not we have deposit insurance has something to do with what my liquidity position will be in the future. Financial engineering can do a lot of that. My relation to the lender of last resort, whether this is a Federal Reserve or in the good old days was a major banker like JP Morgan, has a lot to do with what my liquidity position will be in the future. And then, of course, last but not least, the gap between my old expectations about how the future would work out and actual outcomes will also have a lot to do with access to liquidity in the future. So it's uneven, and that has major implications. In short, I think most people and most regulators today still think that financial markets look something like that, or should look like that, and that's also why they discipline us, or if they don't, we have to fix it with institution, and I'm suggesting actually it looks more like that. It is a musical chairs game. We're trying to get access to liquidity on a daily basis. Only in times of crisis the race becomes more ferocious. Not everybody will get a seat at the table, not in private markets, and ultimately not at the Fed. So just to show you that I think this picture actually is more accurate about financial markets, this is how the balance sheet of the Fed looked like in 2008, 2009. And what it shows you is that actually this was a massive failure of markets that were trying to balance liquidity. And they were racing around and trying to see who gets a seat in the end, and many people did not get a seat anymore in private markets. They could not use the papers that they used in the past to get access to repo markets and other liquidity-providing markets in the private sphere anymore. So the Fed stepped in and took these markets onto its own balance sheet. The one point I really want to make here, because that has the international component, there are two things that are really international. The purple one is the international swap lines. That is the amount of money that the Federal Reserve made available to other selected central banks so that they could provide dollar currency to companies within their jurisdictions in order to continue to pay their claims in dollars. The red colored sphere here is the term auction facility of the Fed. And so this was giving banks access to liquidity as they could no longer use asset-backed securities to get liquidity on private markets. So if we take a look at the banks that get access to this term facility, you had a lot of foreign banks amongst them. By the way, also a couple of Canadian banks, which is interesting, right? They were here too. But lots of them, one point that somebody else made, Professor Shin at Princeton, is that there are no Spanish banks here. That's a separate story and a very interesting one. What I want to suggest is that a bank like, and this is the arrow is not quite correct, Unicredit, the Italian bank Unicredit is here. And that, I just want to spin this further. Why is Unicredit, an Italian bank that bought Kreditanstalt, a major Austrian bank that has huge subsidiary chains throughout Eastern Europe, why do they get access to the term auction facility of the Federal Reserve? Well, it's because this is how global markets work. Unicredit Italy has bought Kreditanstalt Austria. It's now a subsidiary. It then has thereby also, of course, acquired all the subsidiaries in Eastern Europe, etc. You see a major credit expansion throughout Eastern Europe, not because there are so many deposits and savings in Eastern Europe. Effectively, the gap between savings and credits increases, not because they get the savings from Western Europe, from the Austrian banks into Eastern Europe, no, because they source their funds from global interbank lending markets and push it through into Eastern European countries. And that kind of linkage is not necessarily known to the host countries, or actually home countries of the subsidiaries in the receiving countries, in the target markets essentially. But these are the linkages globally that we have to work with, and I think what I want to make sure again that I get that point across, these different countries face different access to liquidity. If Unicredit doesn't get any money anymore from the US, it just can it can still try to protect itself. But that might not be feasible for Latvia or Hungary, where you saw credit growth of 70 or 80% per year for a number of years, and that clearly exceeds the resources of the central banks in these countries, and as we know from the Euro crisis, clearly exceeds also European abilities. So what is really going on in global markets? Banks source globally, and they shift debt to different markets. And the risk of these different countries is very uneven. So the funding markets regulators have an incentive to think about this to the extent that any kind of collapse might affect their own home market, which is why the Fed made available the TAF also to foreign banks. They were fearful of the boomerang effect. The parent company markets are only interested in their own parent company markets, so I'm not sure whether I would share the optimism of Stein thinking that this would somehow depoliticize relations with the host countries. I think it will politicize and maybe strengthen the politicization of the interests of the parent markets, which we already have. And then finally, the target markets, of course, they are exposed to the collapse, and they probably will bear the brunt of the cost when the system as such fails. So in short, I think we have a hierarchy of global finance. I think you can make the same case. You have a hierarchy of domestic finance, and we could think about this, thinking about different institutions in this country. And I think the institutional structure of global finance reinforces this hierarchy, and we should just be aware of that. If that's what we want, we just have to know where we allocate the cost of crisis. The Basel Concordat is one core element here because of its home host division of regulation plus consolidated supervision. We talked about this today already. Therefore, we have only limited liability of parent bank regulators. That was the entire purpose of setting up the Basel Concordat. And the source market regulators bear no responsibility in principle. I think the Fed took on responsibility only because it was fearful of a boomerang effect. Free capital mobility, unrestricted, particularly in the European Union, where countries have to, under the treaty, allow free capital mobility not only vis-à-vis member states, but also third country, in combination with the strengthening of creditor rights, supports the cross-border debt shifting that I've just illustrated. And then finally, the crisis management, I think, has also reinforced the structure. The Fed had bailed out certain markets and certain intermediaries, not all of them, but those that are relevant for the US, and clearly the signal gets across. The closer you are to the US markets, the more likely you have liquidity in the future, and anybody who can think strategically will have to think about how to get as close as possible to the liquidity providers in the future. So, since I don't have so much time to elaborate this in greater detail, what I'm basically saying is we need more decentralized regulation. I do see the fear that Stein pointed towards by saying, my home is my castle. Is this protectionism? Well, to a point, yes. If I have to bear the cost of a crisis, I probably should be able to take some protectionist measures about this. But I want to counter that by saying, let's just get global regulation to match the different risks that different countries and actors face. So we need to have much more coordination of different approaches to regulation that are actor and country specific. We have to coordinate countries that have weak bargaining power vis-à-vis major financial conglomerates to get together and say, well, but these are the basic standards and we will try to hold the line here. And I just want to point out that many countries actually did quite well in trying to do that. In Eastern Europe in particular, countries like Croatia or Poland were trying to fight the credit boom, but their tools were rather limited given our structure of global finance. We need to coordinate policies in the source countries, the home countries, and the target markets to make sure that the impact of the liquidity failure will not be quite as predictable in the end for those who are furthest down the line in the hierarchy. And we need to have global monitoring of access liquidity and its sources. We therefore need some kind of a global information repository for effective liquidity management strategies and sanctioning mechanisms to enforce them. So what do we need? I think we need something very different than the Financial Stability Board in Basel, which basically does not much more than implementing the existing standards, or once more taking a one-fits-all regulatory approach, which does not take into account the different risks that different countries face in this world of global finance. That new coordinator would have to have the credibility and legitimacy to bring different people together, and I think they will also have to work with private sector agents. So it has to have convening power to do so. And it has to be responsive. We need a process of adapting regulation over time. There's been a lot of talk today that we're not done yet, but we have not established in Dodd-Frank or in the global setting actually a mechanism that would force us to rethink on a daily basis where we are in regulation, how we have to adapt. It's not enough to delegate this just to the regulators. They will do their own bureaucratic thing and just implement what's done there. We've always had this problem solving of past problems in regulations, and the next set of regulations comes only with the next crisis, and I think what we need is a different process. So we need somehow to create structures where more learning is possible, where there are diverse views being heard inside regulators, and we don't have the silo thinking that we've seen so much in recent years. And we have to try to set up structures to spot non-routine events. Thank you very much.
I want to thank my panelists. I think it's been fabulous. You've been a great audience.
I'd simply like to take a couple of minutes to talk to you hardy souls who've stuck it out this far. I know it's hard to be here at the very end, and those of you who stayed obviously are very interested, which is terrific. I'm supposed to summarize a little bit what we learned today. I can only do it from my standpoint. It's what I learned today. First of all, I learned that I have a very good partner in Charles Calomiris, who came up with the title of Unfinished Business, which I think is 100% on target and set us up for the discussions that we've had today. Also, I'd like to thank I'm sorry you're all not here, the world-class panelists that we put together. I mean, it was fabulous that Charles is right. We called people up, they came, they prepared papers on their own. This was all voluntary. And it shows that they must have been very enthusiastic and excited about what they were doing. This is a miracle. I've been putting on panels all my life. I've never seen people come as quickly and happily to meet the challenge and produce really unbelievably good first-rate work. So I hope that will be communicated to everybody who's not here. Now, to talk about what we did, as I say, I can only talk about it from my standpoint. I'm sure you will each take away whatever it is you got out of it, but this is what I got out of it. I got out of it that it's very unfinished business. That's what I got. I am convinced that title was superb. We have very unfinished business. Now, how did that happen? I think summarizing what people did, I think everybody feels that Dodd-Frank assumed causations. Nobody proved these were the causations. They just took assumed causations and attempted to install further regulation with respect to each. In other words, they picked out each problem area, assumed that was the problem area, and went and re-regulated. And there's serious debate all day long on whether or not they picked the right causations. In picking them, however, they then proceeded to use the same regulatory approaches that they had always used. There was very little innovation. It was just re-regulating the same old way, the same old things. You did, Katrina. They reinforced the structural hierarchy. Nobody thought about changing the structural hierarchy. They took it as it was and reinforced it with more regulation. I think that's what I saw. Now, did it work? And does it work? I think Raj Cohn was the most moderate of all by saying, well, give it a chance. We just started. Let's listen to how it works out. Maybe it'll all happen. I think it's pretty good. But I do think almost everybody else said it's not working to one degree or another. Not everybody agreed on the degrees at which it wasn't working or what exactly wasn't working. But I think uniformly, I didn't hear anybody but Raj get up and say, this is terrific. It's really working. All we have to do is wait another couple of years, and all the problems will be solved. I heard everybody saying, to one degree or another, this doesn't work. And I think certainly, I have no doubt myself, that it isn't working to one degree or another. Now, that's the negative side. The positive side of what happened was that whether advertently or inadvertently, you all came up to new approaches to regulation, which I think is terrific. I was on the administrative conference for many years, and under Scalia, of all people, but he was good at regulation. I'm not so good at being a judge. He was very, very good on regulation, and his approach was what you all have done, which was to look at the existing hierarchy and think about what changes had to be made based on research and experimentation. Don't jump to conclusions. Let's look at what is, see what we need to change, and then base it on thinking about it and not jumping to conclusions, doing some research and experimentation. Almost everyone who talked today said, we're really not finished. We really got to think about this a little more. There's research to be done. We don't have all the data. We have to know a lot more. I believe that firmly. There's a lot more to do before we really know how to get out of here, where we are at the moment. That was really good, too, because that's what you get when very good academics get together and talk about what ought to be done. They don't have patent solutions. Basically, they have ideas, but they all concede that it will only be as good as the research that backs it up. Now, what were some of the innovative suggestions that were made? As far as I'm concerned, these were them. First of all, I love the idea of using incentives and disincentives, which might install some market discipline. Obviously, as a market person, I think the idea of incentivizing and disincentivizing people to compete and do the right thing is fine. That's an idea that should be thought about a lot. And then monitoring them, that's an idea that should be thought about a lot. Also, everyone agreed it's too complicated. You can't do this with this massive regulation that we have. We have to simplify it, think about the core principles, and come up with simple as we can make it, as Einstein used to say. No more simple than necessary, but simple. And I think this is required. We have gotten into a mode of just regulating and regulating it without stepping back and saying, can't we do this easier? Isn't it a more simple way to do this? And I think everybody who spoke talked about it. The other idea which seemed to carry through from everybody was transparency. The one thing that everybody would like is more information about everything, and that we just don't have enough information. And hopefully, through one thing and another, we will get more information. Maybe the one thing that Dodd-Frank does is flush out through the OFR and other instrumentalities, more information, more transparency, more knowledge about how these markets work today. And then I think the other two things that happened was I sensed a desire to restore markets and competition to the extent possible. We can't obviously recreate the world and have a competitive banking system to the extent that we want, but I heard ideas and innovative ideas from everybody about how we might just get injected a little more competition, a little more market into the mix, and a little less regulation. I'm not going to eliminate all of it. And finally, I think the idea of simplifying international regulation and attempting coordination is incredibly important. I think Dodd-Frank missed the point that no matter what they do, they can't solve this problem if everybody else doesn't help out. This is not a unilateral activity. We can't do it alone. We can't do it even if we join with the UK. There has to be, I think, Stein, and your panel said it, some effort to try to make this thing better coordinated than it is international. Now, my sorrow, my unhappiness is that a panel like this and others like it didn't happen before Dodd-Frank rather than after Dodd-Frank. It's just too bad that we have to do an after-the-fact look at it. Are we too late? I don't think so. And the reason I don't think it's too late, I think that Dodd-Frank is going to collapse of its own weight, and we're going to have to start over again very shortly, maybe in a few years, but it isn't going to work. And so we will be at it again, and I think we will have, as a basis for this panel, and I think other panels to come at Columbia and other places, we'll have a better foundation on which to work the next time we go about trying to solve this problem. So I thank you all for staying as long as you have, and I call upon my partner, Charles, to come up and tell me what I did wrong, as you usually do.
I must be very tired because I didn't hear that you do anything wrong this time. So I guess I'll disappoint you on that. Anyway, before closing, let me just make one additional observation about many of the sessions today. It was striking to me, and of course this isn't the first time it's occurred to me, but today was particularly striking, how much global and particularly cross-country considerations have really started to affect every issue that we're thinking about in terms of financial regulation. And what's striking to me is, because I'm now starting to get a little older, I'm remembering back when I was involved in financial regulatory reform from 88 to 91, how absent that was, despite the fact that the world was financially globalized in the 80s quite a bit too. But the way that things were discussed was so completely different. Let me remind you. So first we heard about, from a variety of perspectives, including some of the comments that Glenn Hubbard made, some that Loretta made, and some that Stein made, that the perceived advantages from allowing sort of flexibility and liquidity across borders was really quite great, and I agree with that perspective. And then we heard from Dick Herring and others that and Stein as well, that this was creating huge legal problems having to do with resolution, lots of other problems, that were really very knotty problems to try to solve. And then a discussion about, in the last session, the tough decisions about the allocation of regulatory power, even if you could get, let's just put aside the resolution authority issues, but just all of the other issues about the allocation of regulatory power, and the need to figure out how to align or at least take account of the connection between that set of decisions and decisions about banking structure, banking flows, ring fencing or not. So I'm just sort of pointing out, in addition to all the things that we don't know having to do with Dodd-Frank, just from a domestic perspective, what's really striking to me is that we can't have a conversation about any country's regulatory reform anymore without becoming experts on international regulation, global finance, and that is a very different world from the way we felt it was just 20 years ago. That's my only substantive reflection. So I'd like to now just thank everyone, thanking, of course, the panelists, the moderators, also Ira for the fun that we've had thinking through what we did, and hoping that with the rest of the faculty in the two schools, we can figure out what the next few steps are going to be. Also thanking Richard Richman, who stayed, which is along with everyone else who stayed, but thanking you not just for staying, but for making it possible. And thanking the staff at the Richman Center, staff at the other Columbia School offices that always pool their resources, particularly Jennifer Tromba, Kathleen Rithersorn, and Joshua Sapphire, who all three really rose to the occasion. We gave them very little notice to organize this conference, and they really pulled it off great. And finally, thanks to all of you for attending. It's been a lot of fun. Bye-bye.
Excuse me, before you go, I have want to make one last announcement that all of the materials for the panels, all of the PowerPoints, and video of the proceedings here will be available on the Richman Center website, and you just type in Google Richman Center, and it'll take you straight there. On behalf of the Richman Center, I want to thank you all for being here. I want to thank Richard Richman for supporting it. And I also want to give a little shout out to the support that we received from Josh Sapphire, Kathleen Rithersorn, but as well as a bunch of people who've been wandering around the room making it possible to record for posterity the work that we've been doing here. So I want to thank Kristen Fehrenbach, Keisha Marks, Samantha Nathan, Ali Newcomb, Sona Rai, Meredith Trivedi, and Jennifer Tromba. Thank you all for coming.